Let's go.
Welcome, everyone, to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. This is Ryan Nauman, the market strategist here at Zephyr. Fixed income has come under fire recently as a lot of strategists have become very bearish on bonds, and this has been evidenced by elevated treasury yields. I have on the perfect guest to talk all things fixed income, the current macro environment, and what it all means for financial advisors as they build investment portfolios. I'd like to give a very warm welcome to Robert Cohen. Robert is the Director of Global Developed Credit at DoubleLine. Robert, thank you so much for coming on the show again, second time. It's really an honor to have you on for a second time. I'm glad I didn't scare you away after that first episode. So thank you. I appreciate it.
Yeah, thank you, Ryan. I'm glad to be back here. It's good to be a repeat guest now. So this has become kind of a regular occurrence now.
I love it. I love it. Maybe we can make it a regular occurrence. Like I said earlier, the fixed income pulse with Robert Cohen.
Let's do it.
Awesome.
That'd be great.
Thank you so much. So, Robert, let's just go ahead and get started. Can you tell us a little bit more about yourself and DoubleLine?
Yeah. So DoubleLine is a $95 billion in asset management firm. We are employee owned, which I think is an important feature that we have all our interests are aligned with the clients. We're not part of some mega corporation where there could be many distractions. So I focus on corporate credit. There are other specialists focusing on, for example, interest rates, mortgages, structured credit, emerging markets. Particularly in this time, the nuances matter. So I think being investment specialists is a better setup than trying to be a generalist and pretend that you can understand everything. So I think that's an important feature of what we have here at DoubleLine.
Yeah, Robert, I couldn't agree with you more on specialists, especially on the fixed income side. Yeah. Equities, yes, they're complicated, but fixed income, there's so much at play in fixed income. And the fixed income market dwarfs equity market. So I feel as if you're a financial advisor or just an investor, on the fixed income sleeve of your portfolio, let the professionals handle it. Let the specialists like you, because when you're trying to manage duration risk and all the other risks that are involved with fixed income, there's a lot more to it. So I think it's very important to be a specialist on the fixed income side versus, like you said, a generalist who they're just doing it to maybe capture some assets under management.
Yeah, I agree completely.
So let's start at the top. We touched on the macro themes here. Investors are faced with conflict in Iran. We've got the national deficit that is the elephant in the room, uncertainty around monetary policies, a new Fed chairperson. We've got sticky inflation. Can you please tell us your views on the current macro environment and just what's on play? Maybe add some clarity around it all.
Yeah, if we were to boil the macro environment down to two words, it would be war and AI. So we started the beginning of the year with the market expecting that the Fed was going to actually lower interest rates at least once, if not twice. And now, fast forward to today, people are talking about maybe the Fed's going to hike. Certainly seems unlikely that they're going to cut. So why is that? What's changed? We have this conflict in the Middle East, which is constraining the flow of oil. Went over $100 a barrel, and it caused concerns about inflation around the globe. And that's feeding into the treasury market. Our internal estimates suggest that inflation, the core CPI, could go over 4% soon, and that it's going to remain maybe not at 4%, but north of 3% for quite some time. It's really hard to say when this conflict is going to end. I'm not going to make a prediction there. But even if it were to end tomorrow, the energy markets won't resolve themselves immediately. And the inflationary impulse from that oil constraint is not going to resolve itself immediately either. So I think we're in an environment where the rate market is correctly assuming that there's an upward bias to inflation. So that's the war part. If we look at AI, seems to be certainly influencing the equity markets. Some people say it's all one trade, which I think there's an argument for that. There are 4 or 5 hyperscalers that are going to spend almost $1 trillion this year and maybe $5 trillion over the next several years. the equity concentration, so the number of stocks in technology, so that sector concentration has never been to find a period where it's been that concentrated. You have to go back to the 1800s, to the railroads. So we really have almost an economy that's tied to all this capital spending in AI. At the moment, it's stimulative, so it's driving equity returns, it's driving economic growth. So that's great, but it also builds risks as valuations get very high. We see credit spreads very tight. And so that's the other side of the worry here. That's in the two-word war in AI, that's the AI side that I think you can't ignore. And we can talk about how to manage that in a fixed income portfolio, but from a macro perspective, I think those are the two things to worry about.
Yeah. Let's talk about that. I'm glad you brought perfect segue, Robert, into how you manage that AI investment. It's huge. Like you said, trillions of dollars from these firms that let's bigger mega tech firms that usually hold a huge amount of asset or cash on their balance sheets. Now all of a sudden they're spending all this money on AI and all these new innovations. Is there how do you handle that in a fixed income as a portfolio manager in AI? Usually we talk about on the equity side, but when you talk about all these expenditures, does that impact your decision making?
Yeah, I think we start with a quite simple proposition in trying to understand, what do clients come to us to solve? What problem are we solving? And I think that we're supposed to be the ballast in their portfolio. Fixed income is the stay rich asset class, not the get rich asset class. And so most everyone is overweight equities, whether they know it or not. And if you own equities, you are long the AI trade, whether you know it or like it or not. And so I think your fixed income portfolio is supposed to steer clear of that, maybe, certainly constrain that. So when we build portfolios, we measure how much AI risk we have in the portfolio. And we want to keep it quite limited, because if you're coming to us for a fixed income solution, we don't want the clients to find out if AI starts to underperform. If we can talk about bubbles, but if there's a bubble that pops, that will certainly cause a major drawdown in equities. We don't want our clients to find out that all of a sudden there's a major drawdown in their fixed income portfolio because we're just doubling down on AI risk. Broadly, we think it's better to invest in the AI opportunity in the equity markets and use fixed income as alternative. I don't want to say a hedge, but maybe something that's uncorrelated. And so we spend a lot of time measuring that. There's a lot of, I shouldn't say there's a lot, there's growing AI exposure in corporate credit and in securitized because of this build out, because these trillions of dollars that are being spent. It's not a huge part of any market at the moment. So investment grade corporates, high yield corporates, securitized in terms of asset-backed securities and CMBS. I think they're all less than 10% right now, but growing. And so we measure it in our portfolio management systems. If we buy more, let's say we buy some Google, or now called Alphabet, we're going to tag that in our portfolio management system because that has AI risk. Not that I'm worried much about Google, but we want to know what the exposure is. There's also all the companies that are the beneficiaries of all this spending. So, semiconductors, memory, even power construction companies like Caterpillar all of a sudden are getting an AI premium. We actually measure all that so that we know how much of this is in our portfolios. Broadly speaking, it's pretty low, single digit exposure. So how do we manage it? We try to just avoid it altogether. And if we're going to have exposure, we're going to have it in places that have very solid coverage from these hyperscalers, or have guarantees or something directly related to that. We can get into exactly how we do that, but the main theme is we try to manage the exposure so it's not a big part of the portfolio.
Yeah, that makes sense. We talk a lot about AI being the revolution and all this stuff regarding AI, and it's going to drive everything moving forward. But it's still awfully early, Robert, in the AI ecosystem. And so to me, there's still concerns. Are these companies that are spending these huge sums, are they going to get the ROI, the return on investment they're expecting? Does that concern you that maybe they're a little overdone in their spending and that those ROI expectations maybe aren't going to be met?
Yes, I do worry about it. There are companies that disclose their profitability, like Alphabet that we just mentioned. They have a cloud computing segment that they disclose in their financial statements, so you can see the profitability there. So that transparency is quite helpful. Many others do not report the profitability, and then many other companies are not yet profitable. They're building out. So the companies that are actually building out this infrastructure capacity, not the hyperscalers themselves, but the ones, the off-balance sheet financings and the separate companies, CoreWeave, for example, the ones building all of this, it's yet to be determined what the return on capital will be. Clearly there's probably going to be winners and losers. I was an analyst during the dot-com bust, so this isn't the same, but as they say, rhymes, but it's rhyming in quite a similar way. There were darlings back then, Cisco, Microsoft, and so on, that are still here today. And then there were other financings that were quite aggressive that wound up not working. And I think that's where we're going to be today. I will say, at least so far, a major difference is I do not think that there's a bubble yet in credit. And I say yet because we're doing a lot of financing, but what distinguished that era, and I think what happens when you have bubbles, is you go from aggressive expectations to transactions that are not going to work. The famous pets.com back in the 2000 era. But even go back to the energy financings of, I don't know, was that 2013, 14, when we were financing the shale boom in the US? There were rock solid credits, and then there were credits that you knew on day one wouldn't work. So if looking at the AI deals so far in the credit markets, the hyperscalers themselves, Alphabet, Microsoft, Amazon, they'll be fine. Their balance sheets are still very strong, even if they put more debt on the balance sheet. Many of the other neoclouds and the ones building the infrastructure, some of them are aggressive, but you can certainly come up with a forecast where they work just fine. We have yet to see the deals so far where you look at it and say, oh, this is not going to work. So that's why I think the credit markets, just speaking about the credit markets, not the equity markets, the credit markets look okay for now, but we are on watch. I'm waiting to see those deals come where you say, oh, this isn't going to work. This is just a bridge too far. We're not there yet. The equity markets are starting to trade. I remember back in the late 90s when people started talking about ARR IPOs, that's annualized recurring revenue. And I remember back then people going on TV saying valuing companies based on earnings and cash flow was an old-fashioned, that's your dad and your grandpa's old valuation method. There's a new valuation method for this new internet era, and it's annualized recurring revenue. You look at that and you look at the total addressable market, and that's all you need to know. Don't worry about the earnings, they'll come later. That was back in 97, 98, 99. Then we had the dot-com crash. We're starting to talk about that again. Not with the hyperscalers. They have plenty of earnings and cash flow. But all of a sudden, we're starting to talk about IPOs. We're talking about companies that we're going to measure based on a multiple of annualized recurring revenue and a total addressable market. And the earnings and cash flows, they'll come later. So, that's certainly yellow flags. I don't know if we're going to call them red, but there's certainly yellow flags. And we're spending a lot of time thinking about that at DoubleLine as we put portfolios together.
Robert, that's fantastic. And I remember during the dot-com era, I was in Seattle at the time. So then it was like just chaos. And you're right. Back then, I don't know if there was a day or a time or a month where all of a sudden, okay, we got to stop. Now we're getting way over our ski tips. We're going beyond going back. And I don't, like you said, I don't think we're there yet. I don't think we've seen that in the AI space where we got to take a step back and be like, what are we doing here? And a lot of it might be because you have those hyperscalers that are front and center, that their balance sheets are strong, fundamentals are strong. So far, so good.
Yeah, I think also the credit markets in particular got walloped back then. And there, I think, is enough institutional memory for now that can evaporate, that particularly in high yield, where obviously that's where the risk sits, the market's been pretty disciplined. There's been a credit curve that's been pretty steep. So you see the CoreWeave that's more speculative, that has, it has a 9% coupon. It was trading, wide of 9 for a while. It's about 8.5 now. And then you have the metas and so on that are 5%, mid 5% yields. So there's a pretty steep credit curve. And I think that discipline, at least for now, is healthy. When all that collapses and everything yields the same, whether you're a total speculative build out or a hyperscaler, then it's time to be really worried. But we're not there yet.
I agree. And I also think too, though, now maybe last year you could just take anything that was related to AI and it would shoot to you got to be more selective now. Like you said,
Yep.
there are some
Yep.
firms out there that they don't have revenue, they don't have earnings. Right now it's time to be a little bit more selective and focus leverage specialists like DoubleLine to select those winners.
Yep.
So taking it back, we had the macro uncertainty, but though then you have these huge AI investments. You've got credit spreads that remain tight, equity valuations remain elevated. But though then you have these macro uncertainties, does it seem there's a divergence there between macro uncertainty, risk, yet markets seem to be doing okay. Credit spreads are tight. What are these dynamics signaling, especially on the income side, the AI investments, credit spreads? What are they signaling? And do you think there is a divergence between the macro environment and these signals?
Not necessarily. So there's a couple ways to look at it, but quite simply, if you're going to shove trillions of dollars into the economy, that's very good for earnings. That is just the stimulus from the AI spending, but there's defense spending, there's other forms of government spending that's also liquidity injected in the market. That's all strong for earnings. So markets trade off of earnings expectations. Earnings so far have been very good. I think the question is, have earnings expectations become too optimistic? That's a question mark. But for now, the markets, in terms of equity valuations and credit spreads, are trading off the fact that earnings are very good and the outlook is pretty rosy. If this liquidity is all going to be put into the market in the terms of capex spending, defense spending, other fiscal spending, well, that's good for earnings. And so, at least for what you can see in terms of forecast, it all looks pretty good. And how does that flow into rates? I mean, it's actually inflationary. So, in a way, those themes are consistent to have higher rates and more liquidity going to the market and more earnings growth. That actually is consistent from a market perspective to have a worry about inflation. I think what was inconsistent is to have an expectation of the Fed cutting rates and falling treasury yields in an environment where you have all of this stimulus going into earnings. So I think actually the rate market and the equity market and credit spreads, I think, make more sense now today if you think of it all as just shoving all of this liquidity into the market. The question is really about growth. Are the growth estimates correct? And if they're not correct, then you could see certainly a drawdown. You could see volatility in equities and in fixed income. And I suppose all of this assumes that inflation does not get out of hand. Now, the forward curve for oil is coming down to something normal over time. If that's right, then maybe all of this calms down and that inflation expectations don't really get amped up a lot. And if we had a significant rise in interest rates, I think credit spreads could not hold where they are now. They're steady on the assumption that the Middle East conflict will resolve itself soon enough, whatever that means, and that oil will start flowing again soon enough. Let's just say 2026. I'll define that as soon enough. That if we resolve it this year, then the market will be able to absorb the shocks associated with the kind of energy shock.
Yeah, Robert, that's a great point. And I'm glad you added that all this spending is good for the economy. And so I'm glad you clarified that. Very important. So you're a specialist in corporate credit. You're the global head of corporate credit at Global Credit at DoubleLine. So let's get your take on the current state of corporate credit. We talked about AI and its impact, but like I said, fixed income has come under intense pressure recently, and people are very bearish on fixed income. Part of me thinks it might be a little overdone, but what are your thoughts on the current state of corporate credit? Should people be bearish on it? I know you're a little biased, but should they be this bearish?
Again, corporate credit is driven by earnings. If you think that earnings are going to be strong, you should be constructive on corporate credit. On top of that, I think the other element is you want to look at borrower behavior. Are we getting excessive lending and excessive risk taking? Well, if we start with investment grade credit, so far we've been in an upgrade cycle. So borrowers are going in the right direction. They're being upgraded from AAA to triple B, to single A, and so on. And so while that upgrade cycle continues, that suggests that borrower behavior and investor behavior is responsible. Put it that way. There's worry in a tight spread environment that borrowers start to relax their creditworthiness. They start to take on more debt, which we're seeing some of in the hyperscalers and the AI spending, but it hasn't broadened out enough to actually hit the index from a broad market perspective. So investment grade looks good if you look at it from the perspective of that upgrade, downgrade. You look at it from the perspective of earnings. Nothing really to worry about. The thing to worry about is tight credit spreads give little room for error, but so far the earnings are there. You can really say the same thing about high yield. Same thing in high yield. Upgrades, not as strong, but upgrades are outpacing downgrades, so we're in a stable market. High yield has the highest credit quality it's had in its lifetime. It's mostly a double B index. It used to be mostly a single B index. It doesn't have much artificial intelligence, AI risk, or technology risk altogether. So from that perspective, it has high credit quality. So the very tight credit spreads are rational. They're not just, they don't come from out of nowhere. They're based on very strong credit fundamentals. So I think that's another thing to look at that's quite positive. If you're looking for an area of weakness, it's showing up in the broadly syndicated loan market, and then by extension, the private credit market, and primarily lower credit quality. The triple C area of the bank loan market has been quite weak. It's been a little bit of improvement recently, but we're talking about spreads. We're talking about all-in yields that are in the over 20%. The spread itself is around 20%. Then you add the base rate, where well into the 20s, and that triple C index trades at around 75 cents. So a lot of that is the overhang from the tight spread environment and low rate environment for 2021. There was a boom of M&A, and those were weak credits. The boom in private credit. So that's the area where you see weakness, and that's something to monitor. Lower credit quality is not performing well. So, B minus, whether it's in the bank loan market or high yield. But I think that was the excesses from 2021. And so we're on alert. But broadly speaking, you put that all together, all these markets, I'd say corporate credit is in very good health, but watch out for the very leveraged transactions. That's always an area to worry about, but I think this is an environment with tight credit spreads and a lot of new issuance that you want to watch out for that. I will point out, though, that another thing that I guess makes me feel okay about corporate credit beyond the overall performance is that credit as a percentage of GDP has been declining since the pandemic. So you generally have excesses build up when you have growth in an asset class or growth in a sector. And since we haven't had much growth other than maybe private credit, which is a whole nother conversation, but for today, we can stick to liquid tradable credit. Those asset classes have been certainly not growing much. And so the risks build when you really grow, and we're not there. I remember 2024 was predicted to be a big M&A year. It didn't materialize. 2025 was predicted to be a big M&A year. Didn't materialize. And here we are in 2026 with the expectation of a big M&A year, and it didn't materialize. I think that's probably a function of higher than expected rates and just general geopolitical volatility. But I also think the private equity sponsors for nearly 20 years now, since the financial crisis, have had an advantage because of very low rates, an advantage over strategic buyers. I think now we finally see that flip where strategic buyers have a advantage over the sponsor, the M&A buyers, the financial sponsor buyers. And so those strategic buyers tend to use debt less than the financial buyers. And I think maybe that's part of the reason why you see less M&A. The M&A expectations have been now just set aside, and now everyone's talking about AI financing. That's really the kind of topic du jour when you're talking about credit.
Yeah, that makes sense, Robert. And on our next episode, we'll dive deep into private credit. That's a whole conversation in itself. And while you were talking about the state of corporate credit, it just kept on reinforcing the topic of it's a important part segment of investing that take an active approach to it, right? Not a passive approach. Take an active approach because there's a lot of segments in it, and like you said, that aren't doing well, but overall, it is doing well. So
Yeah, absolutely. Fixed income is about avoiding losers, not picking winners. And certainly credit selection is going to be very important as we go into this, particularly this AI spend that we're embarking on right now. So it's going to have a lot of issuance across all of credit, whether it's corporate high yield investment grade, but also ABS, CMBS, private credit. It's going to go sprinkle a little bit everywhere. And credit selection is going to be very important.
let's talk real quick about securitized credit. Do you find that maybe that segment of fixed income might provide better opportunities moving forward, or what's your take on securitized credit?
Yeah, I don't think I'm going to say no to start. It really isn't the structure, it's the underlying assets. So, for example, what I mean by that is if you're worried about AI capital spending being a significant risk in the corporate credit market, and you take that same risk in ABS or ABS asset-backed securities or commercial mortgage-backed securities, if data centers are financed in those markets, again, it's the same risk. So if you're worried about hedging your AI risk and you own a portfolio that owns a lot of CMBS and ABS data center risk, well, that's not diversifying the risk either. I think it's more about finding uncorrelated assets to finance, whether it be the healthcare space, pharmaceuticals, or healthcare in corporate credit. You can finance in the CMBS space, hospitals. It could be other assets like warehouses and things that aren't directly correlated to this big AI trade. So I wouldn't say all securitized is the place to be. I think picking the right assets. Mortgages make a lot of sense for a couple reasons. If you look at the non-agency, so the non-government guaranteed part of the mortgage market, the borrowers, where the borrower matters. If you go into agency mortgages, there's no credit risk. But if you go into the non-agency space, credit underwriting has been very tight since the financial crisis. So the loose lending standards that you hear about in other areas did not seep into the mortgage market. And because there's been low housing activity, the high home prices mean there's a lot of equity cushion underneath those borrowers. So you have a low loan to value because you have equity cushion and you have tight lending standards. That's a pretty good combination. CMBS. So I think a reason to like CMBS is that after a calamity, an asset class is usually in pretty good shape. CMBS got walloped with the office space problems post-pandemic. And usually when an asset class gets walloped, investors get religion and become very cautious about credit underwriting. And so you've seen that in the CMBS space. So that's good. But then there's other excesses that we have to worry about. So I think bank loans have a lot of risk, which means by definition, CLOs, if you're lower in the capital structure, have risk. Not that the up in the cap structure AAAs are worrisome, but down in the capital structure, you could have risk because of defaults, because of the credit quality in the bank loan market. So again, why you need active management? You can't just paint a broad brush and say any securitized or any corporate is fine. You really have to drill down into what's happening in these markets. The benefit is that if you have a multi-sector strategy, like most of what we do at DoubleLine, you can pick and choose the pieces of each market that you think make sense. So we talked about the quality of investment grade credit and high yield, and you pick the securities in those markets that you think make sense in the current environment. That probably doesn't fill out a portfolio completely. So you add a little bit of not agency mortgages or CMBS and CLOs in the right parts that make sense. And you build a portfolio that works given the current environment. To switch gears a little bit, I think that the biggest problem that you have when you have single asset investing is you're forced to pick whatever is there in good times and bad. So if you're just a high yield manager, for example, credit spreads are tight and high yield quality is pretty good, but there's still some things to worry about. There are still some bad credits there. And if you're forced to only invest in that sector, You're going to hug quality, which the market's doing, and you're going to miss opportunities to go elsewhere where you can get often the same yield, but much higher credit quality, or at least not any worse credit quality. So it lets you move around in a way that lets you build a more robust portfolio that should give you similar income, but less volatility, less drawdown when spreads widen. And that's really what we're trying to do every day.
Yeah, that's perfect. So let's talk real quickly about duration. And kind of my last question here, topic regarding just fixed income, what's going on there in dynamics and where you view it. Is low duration still the play right now? Or should investors maybe start looking to lock in some of these higher rates? Are we still too early on these rates at these levels?
Yeah, I think our view continues to be focused on lower duration, focused on, let's say, 10 years and in, that the long end of the market is at risk now of inflation, but it also has this risk of the deficit and overall US debt. And so that could cause crowding out that causes rates on the back end to rise. So again, it's a question of what are you trying to achieve with your fixed income portfolio. If you're trying to focus on the income part of your fixed income portfolio, you can generate high degrees of income in different flavors by being short. So that works. If you're looking to hedge equity volatility by investing in long duration assets, they may not work the way they have historically. They certainly didn't work in 2022. Everything was correlated, so rates rose and equities sold off. There's a chance that could happen again. So if we have some kind of equity correction in the next several years, it's certainly possible, it's more than possible, that will be coincident with a rise in rates. Maybe it's the fiscal issues coming home to roost and we finally pay the price of the deficits. It could be inflation. There's a variety of reasons why the rate market may not behave as that hedge against equity volatility. So it really comes down to what problem are you trying to solve. And if the problem is, or your interest is to generate income, I think the lower duration just, you can achieve that. You can achieve that income with lower duration. So why bother moving out on the curve and exposing yourself to that interest rate volatility?
Yeah, I completely agree. There's trying to reduce those risks as much as you can because there are risks out there in moving forward. So very good point. So let's bring this all together, Robert. You added such great insight, a lot of information you shared. It's been fantastic. So you mentioned multi-sector. Is that the play right now too for this current environment, is you take a multi-sector approach? You mentioned it, the benefits of it. Would that be what you do for a financial advisor?
Absolutely. I think the worst thing you could do is be in one bet. So if you just have, I don't know, the S&P and long duration bonds, that doesn't make sense. So advisors can try to do it themselves, but we just talked about the need to be focused and specialized because of the nuances in each of these asset classes. So I think let your manager do it for you. That's our mantra. Like, let us figure out how much exposure you have to mortgages, to rates, to investment grade corporates, to high yield corporates, so all these sectors. I think we have teams looking at this every day. It's hard for an advisor to look at all of these markets all the time and figure out how to move things around. We're looking at it every day. We have teams in this, and this is all we do. And so I think that's the best solution, is let us worry about it. We're looking at it every day. We talk about these things every day, and we're thinking about what the optimal asset allocation mix should be, and we're changing it on the fly as conditions change. So I think that's the winning strategy, because we're going to have conditions change pretty rapidly in an environment with volatility, and you have to be able to move your portfolio around quickly, and that's what we're here to do.
Yeah, no, I completely agree. You brought up the optimal fixed income allocation, asset allocation. I know it for everyone, it's different, right? Everyone has a different asset allocation that is optimal for them. What do you believe right now, though, is more of an optimal fixed income allocation?
I'm going to half punt the question because it really does matter. There's a wide variety of risk tolerance out there. But generally speaking, most people are overweight equities in an environment where valuations are very high. We can argue about growth, but you probably overweight more equities than you should be, and you're probably underweight fixed income. I think because people have not liked fixed income since the 2022 rate of volatility. So generally speaking, you probably want to have a little bit more fixed income and a little bit less equities. And what that means for each client portfolio is going to be different, but I think I can make that broad generalization that given this backdrop of overexposed with high valuations and underexposed to fixed income, when we finally have income in fixed income, you probably need to do some rebalancing towards fixed income.
Robert, thank you so much. Like I said, awesome to have you back on. All the insight, all the information that you share, it's great. I just sit back and listen. I should be taking notes. Thankfully, I can watch this a couple of times over and over. So thank you. It's fantastic. And I love that you came on and talked so much about AI and the risks. We often talk about AI and the opportunities, a lot of opportunities out there in AI, but also there's some risks in how it pertains to fixed income. I think it's fantastic. Where can our audience get more information about DoubleLine?
Quite simply, doubleline.com. That is the link to everything related to DoubleLine. So quite easily, just go to doubleline.com.
Yep, fantastic. Awesome, Robert. Thank you so much. And thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel, Spotify, and wherever else you catch your favorite podcast. Please be sure to subscribe to those channels and give us a follow on LinkedIn. Thank you very much and have a great rest of your week.